The first system in the Arizona rules of trading in the Phoenix phase, which is the trending phase, is the Diamondback standard trade. It's a trade that looks for trend trades when the 170 crosses the 800. We've explained it once in the previous webinar, so this is going to be a quick recording that explains it one more time, followed by a quick explanation of the Diamondback plus Stochastic Trade, and then we'll talk about volume. Let it rip, Sean.
All right. Well, this was the first trade that I back-tested on this system, and we got through basically an entire year of testing on this, and it traded it with a 40 pip stop and a 75 pip profit target, just straight across the board. It produced 1,342 pips in a year. I think we determined about a trade every 3 days. And
on the 5-minute chart.
I mean, really straightforward. One of the easiest things I've ever seen to do, you know, in a trading system. So here's the basic rules for it. We start out like we always do with identifying the trend. We have a basic crossover here, 170 exponential goes above the 800 SMA, so we are looking to buy at this point in the uptrend, and it's simply the first thing that you want to do is wait for the candles to turn to red, showing that the price is moving back down, and then buy the first color change to blue that presents itself. So in this case, it's a little bit small, but right there is the first color change that happens after we switch to an uptrend. So at that point, you would take your position. I put in a 40 pip stop and a 75 pip profit target, and just let it run. As we move forward in time, that one obviously would be a winner. I only did one trade per trend. I didn't have any rules that allowed me to re-enter the trend in this particular system. So I would wait until, I mean, you miss a ton, obviously, but I would wait until the next cross happens. And then once that next cross happens, we get a cross of the 170 back below the 800, which says it's a sell trade. Now you're wanting to sell the market as this thing turns into a bearish trend, and at that point, the first color change now from blue to red. You're waiting for the candles to go blue and then turn back to red. So you would be, depending on what you saw as a cross, you'd be selling either one of those trades right there. That technically is the first trade. If you miss it, you obviously can re-enter on that next cross right there. Again, 40 pip stop, 75 pip profit target, and
as you can see, it does very well
for the next cross. Yeah, it does very well again. We get a cross again very shortly afterwards. The 170 goes above the 800, so we're looking to buy again on the first color change from red to blue, and that occurs right in this area. Run a 40 pip stop, and that one doesn't work out so well.
All right, so we've looked at 3 examples here, and here's what we have again. We've taught it last night in a more expanded discussion, so you'll have everything you need to learn this methodology in that video, and we just want to move on to the other advanced versions of trend trading today. You get a cross of the 170 over or above the 800, and then you have a change of color from red to blue, meaning from bearish to bullish, and then you buy. And that's a trend trade with the upward trend. You hold on to that for as long as possible. Sean tested holding on to that for 75 pips. Or you have a situation where the 170 crosses below the 800 and you're looking to sell. You take the first opportunity you can to sell when the candles change from blue to red, from bullish to bearish, and you take that trade. Everyone here is thinking in the back of their mind, oh my gosh, in these really big trends, I could take every change of color. If you go back in that really, really strong bullish trend, you could see just a ton of changes of color that are gigantically profitable. And the Arizona rules of trading certainly allow you to take a greater number of those trades, not just those ones. All right. Next, let's do a quick review, Sean, of adding the regular stochastic oscillator to the trade. After you do that, I will come in, share my screen, and talk about volume.
Perfect. All right. Again, the regular stochastic, slow stochastic, we did the settings to 60, 20, 20, slowed it way, way, way down. So at this point, we're going to go back to this trade right here that we started with. We have the 170 move above the 800. We have a change of color. We take that trade. What the stochastic is looking to do is to trade with the trend as well. So what we're waiting for now is a dip of the stochastic. Since it's an uptrend, we're waiting for the stochastic to dip to oversold. And once that happens, we're looking for two things. We're looking for a combination of higher volume,
and
or
I'll talk about
volume.
I'll cover the volume if you cover the stochastic.
Okay, perfect. Got it. All right. So we got this oversold, and then I'm looking for a change of color to happen either right in while this is oversold, or as soon as it comes out of that above that 20 line. So in this case, obviously we have an oversold position here. We're still in an uptrend, so we're looking to buy, and I buy on this first change of color that happens at that period.
So what it does is it waits longer to take the first trade. Previously in the Diamondback standard trade, we would take the first change of color after the trend exists. In the Diamondback plus S or plus stochastic trade, we're waiting for the trend to begin, and then we're waiting for the stochastic oscillator to go oversold. So it's a much more patient approach.
Yeah, and it also allows you to get in on some of these in the middle of these trends. You know, it's a rule that allowed me to not just take the first trade, but to wait and let the trend prove itself and take some really quality trades inside of the trend too. So from here, we're waiting for the next occurrence of oversold. We get it there. We get a change of color right here, and I was running exactly the same thing, 40 pip stops. So you would not stop out on that trade.
Right, so that trade does not stop out, actually. It does dip below the entry, but that trade does not stop out. So you get another dip there where it goes below oversold, and there's another trade on top of the first trade.
Exactly. You could choose to add to a position there.
Yeah.
You know, I think that's a very, very reasonable thing to do at that point.
Now, how long do you ride these trades? You might be asking. We're going to talk about profit targets and stop losses in just a moment. So we'll just focus on what you're doing right here for just one more moment.
Yep. One more little trade here. We got a dip below. We're well into this trend. We have a dip below into oversold, and we get a color change right here. 17. It does not stop out, and it ends up, catching
going a long way.
At least that move right there.
And then it sets up all over again.
Yep. Again, you could add to a position here. So it basically what it does is it takes the whole thing and slows it all down, and it gives you some really cheap entries into a trend is basically what I was trying for.
Right. All right, let me look at the questions here that come in about the Diamondback Standard or the Diamondback Plus trade. Here we go. Remember, all these indicators are available in the forum. Here we go. Mike Reed said he can't see the chart. Log out and come back in, and you should be able to see the chart okay. Thank you for doing the webinar. Did you do all this testing manually, asks David Pullen. The answer to that is yes.
Yep, every bit of it.
You measured the Heikin-Ashi candles. Do you determine the stop loss profit target by the Heikin-Ashi, or are you just assuming prices will be in the same ballpark? We're about to look at that right now, Bob, and one really nice thing about this is that the candles don't always line up with the Heikin-Ashi candle, but the regular price candles do often enough line up with them so that we can make that assumption. But when Sean did his testing, he used the real candles for the entries and the exits and stop losses. Let me become the presenter, and I'll expand on that discussion right now. All right, so we're looking at my charts now. You can see an orange line on my chart. We're going to leave that here on the chart, but you don't need it yet. It's an envelope, and we're going to use it in a moment. We don't need the divergence indicator, so in fact, I'm going to get rid of that divergence indicator right now and just, well, I'll get rid of the envelope too. Let's just dump it and just look what we need. There it is. That's all we need right now. We don't even need, at this moment in time, we don't even need the regular stochastic. We're going to dump that off the charts, and we're going to talk about volume, profit targets, and stop losses right now. We talked about this last night, so you can see a repeat of this information in last night's webinar. Also, we have a giant downward trend in the euro that all started when, I don't remember when it started, but it doesn't really matter. Here's how volume helps us in these trades. A lot of people say that volume doesn't apply to the world of Forex. Volume certainly applies to the world of stocks and futures, and so if you trade those instruments, you're going to like what we have to say here. But if you trade Forex, you're going to be wondering, hey, wait a minute, I didn't think that volume really mattered. Volume in the world of Forex measures the numbers of trades taken during one candle. Meaning, if during one 5-minute candle 50 trades were taken or quotes on the platform that you're trading on, then volume is 50. If 100 trades were executed or price changed 100 times during that time, you'd get a volume of 100. It doesn't measure the amount of currency traded. So you could have 100 trades of $1 each, and you could have 100 trades of $1,000 each, and volume in Forex would look the same. That makes it sound like volume doesn't really work in Forex. I did a study when I was the chief market strategist at Interbank FX for 3 months in the year 2008. The first thing I did when I walked in the door at Interbank FX was do a study that measured tick volume in Forex against actual volume in Forex. Then I measured that against different brokers. What I found was it didn't matter what broker you were on. If your tick volume went up in the world of Forex, that was important. Period. That was an increase in volume. It was actually correlated to an increase in volume, the amount of currency traded. And in actuality, in the Asian session, you were going to have less currency changing hands, but you were going to have the same number of ticks that you might have in the Euro session, meaning you could have an uptick in volume in the currency market during the Asian session that didn't represent a huge dollar amount, but during the Asian session it was plenty enough to keep the market moving, as if it were true volume. And I found that the correlation stuck. I also found that when volume spiked on my platform, it also spiked on other brokers' MetaTrader platforms as well. Here's why it mattered. Sean just mentioned trading when a change of color occurs on the charts. Here's what volume does for it. When we have a change in color on our charts, and that is accompanied by a spike in volume on our platform, anytime we see that spike in volume followed by a color change with the trend, those are the types of trades that we're looking for more particularly. Those are the ones we like a lot. Those are the trades that we're really looking to take. Last night I switched to the U.S. Mexican, the Mexican peso, and we looked at that. Today I'm going to look at the euro against the Swedish kroner. Haven't looked at this chart ever before. I'm going to switch it to the 1-hour chart. Haven't looked at it. Same concept here. When you look at volume in combination with the stuff that we just taught you, and you use volume as a filter, you have an interesting experience. You catch some of the better moves. On the cross pairs that no one looks at, and here's a moment in time in the webinar series where we're going to teach you something that no one else is going to teach you anywhere. If you for a moment agree to look at some of the pairs that no one watches, you are going to find with Arizona rules some extraordinary trading opportunities. And I'm not... It's the coolest thing in the world. No one looks at these pairs, but guess what? With the Euro Swedish krona, there are 13 major banks in Europe that trade this currency pair. Guess what? They come online at the same time every day and start trading. Guess what? They trade with the trend. Guess what? If you look at a change of color as the 170 crosses the 800, and that's accompanied by a spike in volume above what is ordinarily happening, guess what you have? You have a really, really nice trend trade that all starts with the crossover with the change of color, and then you get additional changes of color that are accompanied by spikes in volume. Doesn't matter what time frame your chart chart you're on. It doesn't matter what currency pair you look at. This is the British pound, South African rand. Never looked at this currency pair in my life. I'm sure that it's tradable. I'm sure that it's liquid enough to be tradable. It's a 1-hour chart. A spike in volume here is different than a spike in volume on the euro Swedish kroner. That's fine. Look at this change in color accompanied by a spike in volume. That's a great trade. This here is changes in color, but we're not accompanied by an increase or a dramatic increase in volume. When you go to your volume charts and you put the volume on your charts, draw a line across the spikes and limit the number of volume spikes that you believe are tradable to a smaller and smaller and smaller number until you get fewer and fewer of them poking above that line, and you visually represent to yourself true changes in the sentiment or true enthusiasm. When you get a spike in volume that is accompanied by a change in color or the stochastic oscillator going to oversold, when you get a spike in volume at these times, you are getting a high number of market participants that are doing the same thing that you are thinking about doing. And at that moment in time, you are trading with the trend, and you're trading with a group of people that are ready to trade. It filters out a large number of these changes of color in the trend and only trades when volume goes up or when market participants are jumping in with you. Let me say something again that may not have come out and been truly evident at the beginning. For a moment here, I want to introduce something that's never been introduced in the world of currency trading, at least to retail traders, I think. And I'm not trying to be dramatic or whatever, but that's what you're paying money to be here for, is to learn something you're not going to learn anywhere else. I just opened up the world of trading currency pairs that you've never seen before or considered trading. It might sound ridiculous, but the Turkish lira against the Japanese yen. Never looked at it? Do some testing on it. Spikes in volume accompanied by changes in color are some extraordinary trades, and no one else is looking at this anywhere. Nowhere. No one's trading these pairs. They're available to trade on your platform. They execute trades properly. The spread is not ridiculous in every instance. That's not the case. There are reasonable spreads. Take a demo trade first so you know what the pip value of each of these currency pairs is. But then realize for a moment that when you trade exotic, lesser traded currency pairs, something exceptional occurs. Volume spikes only when the major participants in these currency pairs come into the market. And you're not trading against or with billions of people. You're trading with a smaller number of people. And that's important. Suffering, suck at that. Look at that. Look at that. The spikes in volume on these currency pairs that are lesser traded happen because fewer market participants who jump into the market at the same times all the time because they have fixings and market activity guide you much more reliably than on the currency pairs that every other human on the planet is looking at. I guarantee you, no one in the world is looking at trading these exotics. No one. They're liquid enough for you to trade on your retail broker's Forex platform. They are liquid enough. You don't go out there and trade them before you've demo traded it. You don't go out there and do it without any testing. But I'm not talking about spending 7 months to figure it out. These are quite reliable. The British pound, Polish zloty. It doesn't have volume every single hour of the day. It only spikes every once in a while. Once again, never looked at this currency pair in my life. This spike in volume accompanied by this change of color is a nice trade. This spike in volume was accompanied by the smallest change in color that you can barely see on the chart here. Right here. You have a change in color here, a spike in volume, and that's the entry. Once again, no one is looking at this stuff, and the spikes in volume and the changes in color are reliable. Now, if you're trading stocks or futures, you get volume, and you've used volume before, and you're absolutely familiar with it. You already know how to look at volume on those financial instruments. Today, for the first time, some of you are looking at volume in the currency market. Nobody looks at it. That represents an opportunity. The first time anybody ever considers it is when the opportunity opens up to the world. You're also about to consider opening your trading to a number of currency pairs that have never been traded. That's also something that you've never seen before. Now let's talk about Bob's question, which was absolutely spectacular. Let's talk about stop losses and profit targets. Bob asked a really good question. He said, well, you're looking at a change of color in the Heikin-Ashi candles, but does that represent movement that's hard to trade because you're not looking at the candles or the actual price? And the answer to that is no, it's not difficult to trade. In fact, often, Bob, the spike in volume that accompanies these changes in color are actually a spike in the opposite direction that represent us getting a better price than we would ordinarily be able to get. The volume spike happens as a fake out move against the trend often. Fake out move happens upward, change of color happens next, and as you can see here, Bob and everyone else, we're entering on a candle that's quite ordinary. It doesn't look like much. Our stop loss in a trade with that change of color after that spike in volume goes above the highest high the candle's recently made. Or, as Sean mentioned on the 5-minute chart, at a 40 or 45 pip stop. The profit target across the board, whether you're looking at futures, you're looking at currency, you're looking at whatever it is that you're looking at, the profit target's going to come at a previous high or a previous low. Simply draw a level of support and resistance along areas where price consolidated 200 to 300 candles ago on a higher time frame chart. So we were trading on the 1-hour chart there just a moment ago. On this area right here where we had a spike in volume and a change in color. And then we drew a support line across price going back in time over previous lows. And we can identify those quite easily. You go back 100 to 200 candles on any financial instrument, any time frame chart, and you pick a top or a bottom, and you get a profit target. It sounds extraordinarily simple, but it works really well. Sean, Bishop. As you look at questions, Scott, do you have questions? Jennifer, do you have questions, comments, jokes, observations, anything else?
The spike first and color change second, correct?
I didn't hear your question. Sean, did you hear his question?
Yeah, spike change and then spike and then color change. Is that the way that it goes?
Yeah, exactly. A spike and then a color change. That's usually the way it goes. The volume spike happens before the color change in most instances. What will happen is the spike occurs, the price will go up, that will create the change to bullish, and then the movement back down will create the change back to bearish and create the entry for the trade. That's exactly right. Jennifer, any thoughts? Sean, any questions come in?
No, I don't have any questions for you. I'm just enjoying fun.
Thank you.
Yeah, we have a few questions.
All right, Bishop, let her rip. And I'm going to put my earphones squarely in my ear so I can hear these questions as they come in better.
All right. They want to know how you get volume to appear on your chart like that.
Okay.
Instead of in the chart.
To put your volume on the bottom of your chart in MetaTrader, you go to Insert at the top, Indicators, Volumes, and then just choose Regular Volume. Next question.
There's some somebody wants to know if they can use, basically they have regular Heikin-Ashi candles on their charting platform.
That would be fine.
And if those are acceptable.
Yeah, those are totally acceptable.
And then what is a reasonable spread? How would you determine if the spread was reasonable?
It's a great question. If you see a currency pair with a really wide spread, remember that that currency might also have a very big daily range. For example, the US dollar Mexican peso has a fairly significant spread. I don't know what that spread is right this second, but let's take a look. The bid is 76.62 and the ask is 77.01. It's like a 400, that's like 1,000 pip spread. This currency pair has like a 3,000, 10,000 pip range every day. And each pip is worth like 1 cent. So everything is relative. What you want to do is you want to demo trade and look at that spread before you trade. Ideally, your currency pair that you trade is going to have a low spread. But remember, a low spread is relative. If something has a really wide daily range, a spread isn't as significant. So the Mexican peso has a 1,000 pip spread. That's really the equivalent of a 2 or 3 or 4 pip spread on the euro dollar, because each pip is worth so much less on the US dollar Mexican peso, and the daily range of that is so much greater that you're comparing something very similar. Even though the spread's wider, the movement is greater. Once again, before you trade any of them, just take some demo trades on it and look at what it costs you to trade it in margin, and look at what the spread does. And I think you'll find with most of these exotic currency pairs that there's nothing really special about it. If you look at the US dollar Mexican peso, you draw a volume line across the tops of these candles and trade a change of color. No matter what you do, no matter how you slice it, if you get in over here at 131916 in this area, we move in that trend as high as, we go 4,000, 5,000, 6,000, a huge number. It's even more than that. I can't even add it up. It's so many. It's a crazy number. We move like 9,000, 10,000 pips up. It sounds like a lot, but it's really not. It's just a regular old trend move in the US dollar Mexican peso. Other questions?
All right. Is there a correlation between the color on the volume and the change in color on the chart?
A color volume change does not matter. It doesn't matter. We're not going to look at the color change at all. We're going to ignore it. If I could make it the same color, I would.
And is there a difference between the volume that you have underneath the chart versus the volume that's in the chart? Is there a difference in?
No, it should be exactly the same.
Yep.
Just easier to see below. Yeah. You can see here, this is the dollar Japanese yen. It spikes only at certain times. This is the 1 hour chart. Once again, changing color accompanied by volume change is a big deal. And it separates all of these out. Classifies the strength of the move. All right. Any other significant questions, comments, or jokes?
Rob?
Yes.
I'm wondering how many trades this produces for you.
In each trend, if you use the volume with it, in each trend on any time frame chart, it will produce, at the lowest number, it's going to produce 1. And at the greatest number, in any trend on any time frame chart, it's going to produce as many as 5, but probably not more than that. So in the midst of this downward trend on the dollar yen, we might get 1 at the very beginning if we take an early entry here, and then not another one until over here, and not another one until over here. So 3 in this trend so far. And in order to get another trend in this downward move on the dollar yen, we would need a spike above this line on volume, and that would create an opportunity for us with the change of color. So that would produce at the most so far 3,
question?
And at the fewest maybe 2 so far in this trend.
One more question for you, Rob.
Yeah.
I'm wondering if you're estimating your stop loss based on recent support resistance lines, and so there could potentially be a large difference in how big your stop loss is going to be from trade to trade, just depending on where those lines are. Is that correct?
That's correct.
So do you calculate your trade size based on each individual trade and how big that stop loss has to be for whatever market you're looking at?
Yeah, let's say, for instance, that I'm trading a $10,000 account and I've committed to only lose $100 per trade, or 1% of my capital. Let's say also that I want to take this sell trade on the dollar yen right here in this upper portion where volume spikes up and we get a change of direction. Volume spiked up because we got a tick up against the trend. Once again, Scott, that is an awesome place. That is just a really great place to trade. And for those of you that are quite daring, I have a suggestion for you. When you see that volume spike up on that bullish candle, sell that spike. Get a change of color and add to your trade, and your stop loss, Jennifer, goes above the highest point that it went so far on that spike. That means that we're going to have, in this instance, approximately a 40 to 50, 60 pip stop on the dollar yen. I can't have that represent more than $100. So my trade size is going to be $2 a pip or too many lots, so that I can't lose if it stops out more than $100 or 1% of my account. The closer I trade this to the spike, the larger my trade size can be, because my stop loss will be smaller. So if I trade it on the spike, now Scott, I can imagine you and I doing this. Right up here, jumps up, volume spikes. We trade it near the high at the close of the candle, 81.43. Stop loss just above the high of that candle at 81.45. So the spread, it's the spread plus 10 pip, 12 pip stop, and a profit target at a previous low down in this area. So we're looking in that instance at an 80 pip target and a 15 pip stop if you want to be really, 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 really quick about your trading in this methodology. And so Jennifer, yeah, we're gonna have a volatility based stop. In other words, if the market's truly volatile, our stop's going to need to be wider, and we might have to take a second chance, or wait till later to take the trade because it's just too big of a stop. Bishop, other questions?
I think we're ready to go.
All right, I'll stop the recording here. That was volume and stops and targets again, and we'll be back and we'll talk about the new trades.